Good morning, everybody. It's Tuesday, October 8th, and this is the AgYield War Room. I'm Dan Dempsey, and I'll be moderating today's session. As always, if you've got any questions or comments, please feel free to drop us a line in the chat area, and we'll be sure to get to it during the show. Overnight markets here, December corn down 3.5 at 422.5. January soybeans were down 15.25 at 1037.25. And December Chicago wheat was down 3 3/4 at 588 3/4. Yesterday afternoon, we had crop progress and conditions out. Corn came back 30% harvested nationally versus 21% last week and 31% for against last year. Soybeans, 47% harvested. We're moving pretty quickly there. That was against 26% last week and 37% from a year ago. Winter wheat plantings were 51% complete. That was versus 39% last week and 52% from a year ago. This morning, the USDA announced an export sales announcement of 166,000 metric tons of soybeans to China for 24. And lastly, we are through 5 of 23 settlements for the harvest price discovery period for crop insurance. Corn is currently sitting at 428 and soybeans are at 1046. Good morning, guys. Lower soybean market overnight. I know that the Chinese stock market reopened there after holiday. It was sharply lower. And I think that, folks were looking for maybe a little better guidance on some of the stimulus they were looking to do for their economy. So with that, Ben, I know we will piggyback a little bit off of yesterday's options discussion. And I know you had just a few things to add here this morning, and then we'll throw it around the room.
Yeah, we talk a lot about options and option volatility, and we find that it to be a very useful tool in managing risk. And just wanted to go through kind of what that means when we say things are cheap. So volatility is measured on a percentage. Typically, in corn, you might see anywhere from, sorry about this, it's landscaping day at the office. On a wider time frame, corn volatility, you might see as low as 14%. Might see as high as high 20s, low 30s in the subcontract when we have peak uncertainty. But the volatility is referring to the likelihood of a future price change based on the current underlying price. And the lower that number is, the cheaper the options get. And it's not, so today you have March corn vol 16.5, 17%. That's definitely at the very low end of the range, and some of the cheapest vol we've had in a while. And it's a factor of how much we're moving around, just not on a daily basis, but on an intraday basis. And also, who are the participants in the market? Are they buying or selling options? They can be, volatility can get disjointed on a daily basis, but you'll see more often than not, kind of it'll always revert back to the mean as long as we're not in a crazy type of market. So, for example, if someone came today and decided they want to buy 10,000 puts in corn, and that's the feature trade of the day, you probably see volatility go up a little bit. But if we're not moving, nothing's getting crazy, you'll see it kind of stay and not get disjointed unless we start having wider moves. Harder for people to manage those short positions. And more often than not, when you get in a risk off situation, you'll see vol spike a little bit. Unexpected moves, people refer to black swan type events. But when we look at it from a 10,000 foot view, it's what is the value that's being provided at the cost that's offered if you're buying them. And then, what is the risk of selling it when it's higher versus the conditions that you have to manage it in. And we mentioned yesterday that, we thought volatility was cheap, considering that we just had a big move, that spreads had tightened. Looking at a little bit longer time frame of a WASDE report, a couple options expirations, early stages of South American growing season, final report, election. So there are a lot of things out there, and there's ways that you can couple those options together to even decrease the cost a little bit more. Certainly that comes with a trade-off. But what you're measuring is what is the perceived daily move on that underlying. When you take that, you take current price times percent, you get a pretty good idea of what they're looking at. So I hope that does a little bit better job of explaining when we talk about volatility. It's a measurement of movement. It directly impacts the cost of participating in long options and the risk of selling options. So, there's other things that go into it The market is kind of an amoeba. You can see slopes. You typically in the grain market, you would see lower volatility on the downside, higher volatility on the upside, simply explained by the fact that in theory, we can go unlimited higher and we can only go to zero, except for, we saw what happened in crude oil. So that's been a little bit dispelled here in the last 4 or 5 years. Interestingly enough, if you look at options today, you kind of see a little bit more of a U shape where some of the way downside puts are still holding value. There's a little bit of trough between here and call it 390, 380, and same thing with calls. Not completely out of the ordinary on the upside. And as you get closer to expiration, but it's a little bit early for that, I think in March, just historically speaking. So that's what I have for you on volatility. I hope that helps explain of what we're talking about when we say things are cheap.
Yeah, and it's the cost of insurance, right? So the market's not too concerned with a large move from here. I mean, is that fair to say?
Yep, I think that's perfect in layman's terms.
Dustin, what's on your mind this morning?
Beans starting to kind of fall a bit here, losing some of that strength as we press into harvest. Probably a lot of beans are making their way to the delivery point. Same with corn. We failed the 100-day yesterday, and then we're finding weakness today. Wheat failed the 200-day, and it's finding weakness below the 100-day again. So I just think you run into that point when you get into that gut slot of harvest for corn and beans where you will start to fill up bin space and fill up bag space towards the tail end of harvest. And I still think that that situation that developed last year is on the forefront of everyone's mind. It's like, well, I've got a nice rally off the lows, 10% off the lows. I don't want to get caught into what happened again last year, which was a break after crop insurance. Long before loan renewal, I think you see more selling. And so I'm just, I could be convinced of anything. If we have a 181, 180 yield, then I see the reason for corn to find recent support and maybe stay there, especially after harvest. We've heard a good number of anecdotal yield reports, though, that have been record in Illinois and Iowa so far. And so I would not be surprised for it to be 183 or above, just based on that. I know there's a lot of growing regions around the country. We've got, some other quantitative data that suggests that yields should be pretty good this year as well. So I'm of that point where I'm like, let's not try to outguess where that's going to go and just focus on the little bit of data we have from your own farm. If you are getting above average yields, we're definitely a more willing seller. If you're nervous, and fear of missing out on a post-harvest rally, there are lots of other ways for us to go get a floor. And I think incorporating some spread coverage, we can do that with limited risk, and still end up, I think, with a fairly strong outcome, even if the market rises. So that's my focus today, is just, trying to keep pushing on that. If you have more to sell, give us a call. We'll talk about ways to go through that, especially as we get towards the middle part of this insurance expiration. We should be looking at that.
I just add on to that. I think you bring up a good point about space. And we had such a dry finish, a lot of people were forced to go get beans. And you're never going to overwhelm the space today with the rate that soybeans are coming in, right? It's moving a little bit slower. It's a lot less by volume. But we're quickly going to see people switch over to corn. And corn's been bid on little breaks here because we haven't really got into that full scale harvest mode yet. But I think that starts here in the next, over the next 7 days. And that's when things can get really problematic from a logistics standpoint.
And
yeah, just look at some of these spreads. Like Dees March is, into 16.5 overnight. Last year it was 26 cents on the day before first notice day. We've got Memphis River levels that are dropping quickly again. Very little rain forecasted for the upper Mississippi Basin, western basins. So I think the river levels could play a part in that. If you're if you're looking at things like, the 10-year rate has been rising again, even though we've started cutting rates in the short run. Long-term inflation expectations are starting to rise again. Perhaps the market will still, have a bit of fear that we can't cut too soon and too fast, and that the cost of money is still nothing right now. It's, everyone's still kind of thinking about that 8 or 9% operating line of credit they have, and the need to raise cash long before we get into loan renewal season. So, last year, a lot of people blamed Dece March going to 2,600 on the fact that the river levels were record low at that time. And I'm sure that had a big part of it. But by the time we got to Feb, we, just not to be a dead horse here, but it was really the transfer of ownership from grower to commercial is when the spreads finally collapsed from March on out. And so that's, I think, what is going to be a big thing is we are expecting a 2 billion plus corn carry out, maybe 2.1, 2.2 if the yields are a little bit better than we expect. Are we capable of getting to 60% of full carry, 70% of full carry, on some of these longer time frames, 6 month or 12-month carries? And I think the answer is yes. It just has to happen toward the later part of harvest when we're running out of space and the need to raise cash is a bit higher.
Yeah, and to that point, Dustin, same thing. The amount of bushels that will be harvested, in the next month will be record. Just by the outlook of the weather, the speed that people are going. To Ben's point, we're like our farm, we're switching over to corn now. We're done with beans. That's going to happen all over the country at the same time. And the crop, Kevin Kennedy said it when he was on here last week, the crop's drying down really fast. So people are going to be going, full bore trying to get this crop in. And I think that second half of harvest, which we'll call that, I think by next week, we'll be kind of entering that phase where there's going to be so many bushels that have to move, find a home. So whatever you think of the yield, whether it's 180 or 185 or whatever, it's still going to be a ton of bushels that have to find a home in a short amount of time. Right. So to your point, spread risk, basis risk, flat price risk, those are all real factors here in the next, 2 weeks to month and a half.
I did get a sense too that there was a lot of people that had a tremendous amount of relief and kind of dispelled the fact that we could actually go lower again on this last rally. And I know that's conjecture, but I definitely think that when you look at the timing, how things worked out, getting Chinese stimulus, I think it was a gift, and give people an opportunity to shore things up a little bit before we get to this period we're talking about.
Yeah, and I think too, if you look at the corn balance sheet globally, you can kind of get a little friendly, I think, like medium to long term, but that's medium to long term. That's, first quarter next year, so there's some slightly friendly things in the corn balance sheet, I think. Cost of production, there's a credit crunch going on in South America right now as well with financing. Input costs are hurting them as well. So there's definitely some medium to long-term, very friendly things in corn, I think. Beans beans need a South American drought to make the balance sheet look good. Otherwise it looks pretty burdensome. So, I think all those things are, Q1 next year, personally. I think you got to get through this harvest, through fall, see if demand can pick up, see if the China stimulus, helps kick up their demand for commodities a little bit. But those are all 2025 subjects, in my opinion. So we got to get through this next quarter, and then I think things could look a little better.
Oh, very good, guys. Ryan, we're going to be coming into the open here. Good start to the week for cattle yesterday. What's your thoughts as we start here this morning?
Yeah, it's just kind of mixed action overall in the meats. After first notice day, No deliveries were posted, so I think everybody's just kind of keeping their eye on the front end of the market. And as of right now, the expectation for cash is going to be firm this week. We've really seen a surge back in beef prices. Choice at 305, that was up like 335 yesterday. Select 289.33, up 172. So the momentum is definitely on the positive side here. So I think maybe if we can see cash kind of more steady, if not firm, I think it just kind of confirms that maybe we've hit a little bit of a seasonal bottom. Maybe beef prices are going to start to going to continue to increase from here just over the next several days, possibly even several weeks. So I think there's just a little bit more optimism on that side. Overall, it was kind of a light kill. So I think just right now, everybody's just looking to cash, and it's probably a slow start, but right now that's kind of all the market has to go on. As far as the hogs go, it's kind of mixed action, but still new highs in December. The market just really keeps on pushing through here. Cash was higher. We were up $1.79. And the cutout was higher as well. So just a lot of good information on the meat side of things. And I think just in general, the money flow has been to the positive side of the market. So at this point, we're really just not, it doesn't feel like we're really trading supply. It feels like we've got some legitimate demand just kind of holding us up right now. So we'll see if that lasts or if just kind of a blip on the radar. I think there's going to be a little bit of caution here just because, there's some rumblings of, some problems in the Hong Kong stock market just being down 9%. So we'll see if that bleeds into our markets. I don't know if it will necessarily, but just something to keep an eye on.
Very good. Appreciate the update. We're just coming into the open here. Got December corn down 2.5 at 423.5. January soybeans are down 13.25 at 1039.5. And December Chicago wheat is down 2.5 at 589.75 is the last there. One programming note, we will have a special guest on tomorrow morning to talk about harvest in their area. We got kind of a northern Illinois farmer is gonna be on with us in the morning, so be sure to tune in. That should be good times. We appreciate everybody that tunes in on a daily basis. If you would throw us a like or subscribe, certainly helps us with the YouTube world, and it'll keep you up to speed on everything AgYield. So throw us a like or subscribe. We certainly appreciate that. Every morning that the markets are open, we're streaming live on X, Facebook Live, and YouTube Live, 8:15 Central Time. Appreciate the thoughts and comments here this morning, guys. It was a good conversation. Hope everybody has a great day, and we look forward to talking again tomorrow.
The War Room is proudly presented by AgYield. For over 50 years, the AgYield team has provided grain marketing and risk management solutions for growers across the country. Our veteran consultants harness cutting-edge technologies to pinpoint risk, optimize market performance, and protect your farm's profitability. Discover a new approach to farm revenue management at agyield.com.
Hey guys, Jack here. Be sure to support the show by hitting the like button, leaving us a comment, and subscribing to the channel for all the latest updates. Thanks for watching. We'll see you next time.